They say history doesn't repeat, but it rhymes. And if you listen closely, you can still hear the echoes of 1929, the whispers of panic beneath the roar of a market that thought it could never fall. Imagine it, late summer, Wall Street humming like a living machine, tickers spitting out endless strings of numbers, fortunes being made every hour, newspapers calling it a new era of prosperity. Everyone believed it, from the shoeshine boy quoting stock tips to the bankers in their $1,000 suits. But beneath the champagne and the confidence, the cracks were already spreading. The people who really understood money, the insiders, the old traders, the men who had lived through panics before they felt the air changing. It wasn't panic yet. It was something quieter. The sound of a system straining under its own greed. Joseph Kennedy was one of them. He'd built his fortune through calculation, not luck. In 1929, while everyone else was buying, he started selling. He'd seen the danger of leverage, the illusion of wealth built on borrowed money. He told friends, when the shoeshine boy gives you stock tips, it's time to get out. By October, Kennedy had not only sold his positions, he was betting against the market itself. Bernard Baruch felt it too. A veteran of the 1907 panic, he had learned that optimism is the most dangerous drug on Wall Street. By the summer of 1929, he liquidated much of his portfolio, turning it into cash and government bonds. He watched the frenzy from the sidelines while the crowd shouted louder, believing prices could only go up. Foreign investors also began to retreat. British and European banks quietly pulled their money out of American markets. They saw the tightening credit, the rising margin calls, the storm gathering offshore. Margin debt had exploded. Millions of ordinary people were buying stocks with money they didn't have. 40% of all stock purchases were made with borrowed funds. The entire market was a pyramid of promises that could collapse if prices slipped even slightly. Inside corporate boardrooms, the smart money moved first. Executives began unloading their own shares in silence. They didn't announce it, they simply sold into strength, while the papers called it the golden age of capitalism. Volume on the exchange soared, but few understood that it wasn't enthusiasm, it was distribution. The professionals were leaving the table while the crowd rushed in. Even the bond market gave warnings. While stocks soared, bond prices quietly climbed too, a sign that investors were seeking safety, not risk. And across the Atlantic, central banks started hoarding gold instead of dollars. They sensed that something fundamental was breaking. By the autumn of 1929, the American stock market had become a casino. Banks lent recklessly to brokers. Brokers lent to anyone with a pulse. Factories were producing more goods than anyone could buy, and wages weren't keeping up with prices. The country was rich on paper and hollow underneath. Then came October. At first, it was just a tremor, a few down days. But when the selling began, it spread like wildfire. On Monday, October 28th, panic broke out. The ticker tapes ran hours behind. Traders shouted themselves hoarse as prices collapsed faster than anyone thought possible. By the end of the day, billions had evaporated. And that was only the beginning. The next morning, October 29th, the market opened to chaos. Phones jammed, orders failed, and rumors spread faster than truth. The great names of Wall Street, the Morgans, the Rockefellers, tried to stabilize prices by buying blue-chip stocks. But the wave was too strong. $23 billion in wealth disappeared in 2 days. Behind the scenes, it wasn't just panic, it was precision. The insiders had already positioned themselves. Families like the Kennedys and the Baruchs had moved their money to cash, to gold, to government bonds. They had escaped the blast before it hit. Others even profited, shorting the very stocks that now burned to the ground. For most Americans, it was devastation. Bank accounts frozen, mortgages foreclosed, factories shuttered. By 1932, unemployment reached 25%. An entire generation learned the difference between wealth and illusion. What few realized then, and what few realize now, is that the Great Crash didn't come from a single spark. It came from a chain reaction of arrogance, credit, and belief. People stopped asking questions because the profits felt too good. Newspapers cheered the boom, brokers encouraged more debt, and politicians celebrated endless growth. But the warnings were everywhere. Rising interest rates, shrinking margins, foreign capital fleeing the U.S. Every major crash in history gives the same signs. They're just ignored until it's too late. On the eve of the crash, the signs were unmistakable. Banks quietly raised collateral requirements. Insurance companies dumped stocks and moved into government bonds. Commodity prices fell as traders began pricing in an industrial slowdown. And the dollar, once untouchable, began to weaken as foreign investors lost faith. On October 28th, major banking families met behind closed doors. The goal wasn't to stop the collapse, it was to survive it. Some coordinated sales. Others arranged emergency credit lines. The public never heard about those meetings. They were the quiet moments when the next decade of power was decided. When the crash finally hit full force, the system behaved like a controlled demolition. The most leveraged players were wiped out first. Then the small investors. Then the banks themselves. Credit vanished. Panic spread. Within weeks, the illusion of endless prosperity was gone. But for a select few, the chaos was opportunity. Jesse Livermore, the legendary speculator, had studied every panic in history and bet against the market weeks before the crash. While millions lost everything, he made over $100 million in 1929 money. He once said, "The market is never wrong, opinions are." He didn't believe in stories. He believed in math, in cycles, in history. The irony of 1929 is that it wasn't really a surprise. It was a reckoning that everyone saw coming, but no one wanted to believe. The data was there. The warnings were public. But greed blinds even the intelligent. As the dust settled, the same cycle repeated. Investigations, reforms, promises that it would never happen again. Yet by the 2000s, the same behavior returned under new names. Credit, leverage, speculation. Different technology, same psychology. And here's the uncomfortable truth. The yield curve, the leverage, the blind optimism. They all look hauntingly familiar today. History doesn't announce itself. It whispers. And if you listen, you'll hear that same hum. The one that played on Wall Street in 1929, right before the music stopped. Every generation believes they're smarter than the last. Every bubble believes it's different this time. But the pattern never changes. The insiders move first. The masses arrive last. And when the fall comes, only those who read the signs survive. The Great Crash wasn't just a financial event. It was a mirror held up to human nature. The desire to believe, to belong, to profit, even when the truth is screaming in plain sight. So, when you hear that everything is fine, that the market always comes back, remember the autumn of 1929, the days when confidence was infinite and wisdom was scarce. Because history isn't just something that happened, it's something that happens again.